All right. Hello, Lou. Can you give your name and the name of your business for everyone listening?
Yeah, I'm Lou Pacelli. I'm the owner and founder of Navigator CFO Group. We are fractional CFOs that service small to medium sized businesses, primarily real estate developers, real estate investors, as well as traditional businesses, more traditional businesses like distribution, manufacturing, and also retail and service industries.
Excellent. And today we are going to really focus in on the real estate and construction industry. Can you just give just an overview of your high level experience in the industry?
Yeah, I mean, it depends on what type of real estate. If you're talking about a real estate developer, their main concern is having the capital, the wherewithal to see a project to completion. A lot of that is about the experience and about their longevity in the business, and a lot of it's about their reputation. Do they bring deals on budget? Are they really reliable as far as their financing and ability to complete a deal?
So, what makes financing so challenging in that industry?
Well, when you're financing projects, it's pretty much driven by the economy, and if the economy is good, if the construction market is good, lenders are willing to lend to really highly qualified developers. One of the issues that a lot of developers have is reputation. They need to maintain their reputation, and that's where I come in as far as developing the budgets, reporting the information to the financial institutions in the way that they want it, so it lends credibility to the developer. That goes a long way with lenders as far as getting the quality lenders, getting the quality financing you need. And you have to have a reputation for integrity. You have to have a reputation for delivering on what you promise. As far and I mean, there could be circumstances beyond your control where budgets get, there's change orders, but mostly you want to bring the deal in on budget in the time frame you anticipate. And if you do that the majority of the time, you'll over time you'll develop a reputation in your market, and you'll be able to do larger and larger deals.
From the bank's perspective or from your perspective, are you going out and talking to past customers, past clients to get a gauge of that reputation, or how is that reputation measured, or what are some of the qualification criteria?
Well, as a banker, they tend to be in the market. If they're construction lenders, they tend to be in the market, and it's a small group of people. They'll in their market. Like for example, if you're in my market in New York, it's a small group of people generally. You're networking with all the lenders, the attorneys, the other ancillary service people that work around that building. And you talk. You pretty much know who's who, and that's generally how it's done. It's old school. It's really getting to know people face to face and really connecting.
And so you have a lot of those relationships in that industry. You know some of the key players there.
Yeah, in my market, I know most of the key players. I know, and I know who can bring a deal in, and I also know some, some not so good good people. Yeah, in this business, like anything else, you have to be careful. You have to know who you're dealing with, and what I bring to the table is credibility in the form of knowing how to present the financing package to the lenders.
To the lenders, yeah, and speaking that language to those lenders and understanding what they look for in terms of the reputation and the qualification criteria.
Mm-hmm.
So, if developers they don't have collateral, how can you help them secure financing?
Well, I mean, when you're developing a project, really all you have is the land value. So they will take the land value, and obviously they'll sell the land if they can't finish the project. But the land value alone is not going to cover the amount of the loan to construct. Obviously, ultimately, bring permanent financing in where the finished product is the collateral, the improved land with the building or whatever's on it. But until the project's done, you pretty much set up a system of checks and balances where you're at every level of the project, you're evaluating where we stand, you're evaluating what percentage of completion, and you're only financing the percentage of completion that's done. So in other words, you'll set up a $10 million line of credit, but you won't fund it. You'll fund it as the project progresses. So that's how you kind of hedge against, you handle some risk. You're not putting all $10 million up front. You put it as the work is concluded. That's why developers have to have a little bit of wherewithal as far as capital, because initially they got to put some money up. There's soft costs they got to put up. Soft costs meaning like, the price for architecture, accounting fees, and engineering surveys and all that. So that all has to be done. And those costs are generally, put up front. Right. Before the financing even starts. So that's where a lot of developers get hung up, where they don't have that money to put in up front. And that's the barrier to entry, if you will.
Mm-hmm. So what are some creative ways that you've helped developers get the capital they need to have those kind of pre-construction costs, the architecture costs, the engineering surveys, so that they can get a project up off the ground?
Well, that's where the quality of the developer comes into play in their experience. They generally have to start out small with small projects and build their way up. They can't really just jump into like a $1 billion project. They have to start small and build their way up over years. So if you have a smart business owner, developer, they're gonna have years of experience. We're gonna look at their years of experience. We're gonna look at how they handled their years of experience, because you could have years of experience and not handle financing well, and still always run as a small operation because you can't seem to get out of your own way. A good developer is going to hang on to capital, reinvest that capital into the business from project to project, and grow over time.
Okay. Lou, you shared with me the other day when we weren't recording a story about how you were partnering with a commercial building in Illinois.
Yes.
Can you share that story?
Yeah, me and a partner, we set up a syndication firm. And what syndication is you just find investors, you call them silent investors, or we call them limited partners. In other words, they're just putting up the capital, and my partner and I are the general partners. In other words, we manage the operation. We went out, we acquired the property, right? One of the, it needed rehab, it needed work. So my partner is a contractor, so he knows how to do the contracting. I know how to do the financing, and I know how to do the accounting. So I did all that, and together we worked well together. We had to build a building because the project was 11 buildings on about 8 acres in Illinois, which is right out this section of Illinois, southern Illinois, it's actually near Missouri. It's near St. Louis. It's literally over the bridge from St. Louis, Missouri. We built one of the buildings, needed a total rebuilding. We had to rebuild it. So we secured about $1 million it cost us about $1 million to build it. We secured about $1 million in financing to build the building. And we did that. We did that with really no reputation in the market, which is really good. I worked with the lenders. I worked very closely with the lenders, and I provided all the documentation, all the financial reporting that they needed in the format that they like to see it, that I know they want to see it in. It put them at ease that we could do the project. Between me and my partner, we created the budget. He gave his expertise on costs because he knows the cost of materials and stuff. He knows the cost of labor. He handled all that. So he gave me that expertise, and I just laid it all out. And we came in on budget. I mean, there were some change orders. We changed some things along the way, but for the most part, we came in on budget and on time on that project. We subsequently refinanced out for a 5-year term loan, a little higher interest rate because the market changed on us. But even at the higher interest rate, we're cash flowing now really well, and we're able to pay our investors a dividend in excess of 15%. Even in this market, which is pretty tough, we're doing really well with this project, and I think it's a testament to our expertise.
What is a CMBS for those who don't know?
CMBS, it's a commercial mortgage-backed security. In other words, like these loans are subsequently sold on the open market as securities. Residential mortgages are done the same way. One of the bugaboos about it is back in 2008, that's what caused the banking crisis. A lot of residential mortgages went south in those mortgage-backed securities instruments. But that was on the residential side. On the commercial side, we're a little better. Our loan is performing really well, even at the higher interest rates, because I was real conservative with our numbers. I know the market, and I knew interest rates were going to probably go up eventually, and they did. And even now at the higher interest rate, we're still cash flowing. We're still providing cash flow, sufficient cash flow to bring a nice dividend to our investors.
And that's what they want to see.
That's what they want to see, exactly.
All right. So, Lou, I want to shift us to owners of developers and real estate firms who they're looking to grow or stabilize their cash flow. Just to your point, cash flow is what you need to be able to provide those dividends to investors. What's your advice to owners in this industry who are looking to grow or stabilize their cash flow?
Well, the main thing is be realistic when you buy the property. Obviously, if you're buying a raw piece of land, you want to be realistic. You want to be in a market. I mean, like, for example, the New York market now is so hot. It's so hard to buy. That's the reason we're in Illinois, is because we're in New Jersey, New York market, and we have properties here. But we bought them years ago when they were cheaper. Now the market is so crazy here. So you have to be realistic, and you have to be willing to maybe move markets a little bit and go into markets you're not familiar with. If you're on either coast, you're right now you're in trouble because there's nothing worth buying. So you have to go into other markets that may not be as familiar to you, because it is very localized. The business is very localized. You know your market. But if you have to go to the center of the country, it's different. If you have to go to Texas, it's different. If you have to go to Florida, it's different,
Being flexible. And how about having a financial vision? What's the importance of having a financial vision?
Well, one of the things I try to do with developers or anybody I consult with is I try to bring out their goals, whether it's personal goals, business goals, aspirations, dreams, what they want. You bring all this out on the table and you say, okay, we're going to build a business around that. And I'm going to tell you what you're going to need to do, how you're going to need to reinvest that capital, how you're going to need, at least initially, you may not, you'll take your salary, but you're not going to take big profits out. You have to put those profits back in. You have to develop that level of capital that I was talking about earlier, that a lot of developers that don't have the financial advisors, they'll tend to take the money and not put it back into their business. And then they don't understand why they can't get financing. Generally, the bank puts up 80+% of the finance. And that's essentially, they're your partner. They're your majority partner. So if you're putting up 20, 30%, you're doing well. But a lot of times, owners that don't understand that want to put up a lot less. I always laugh when I hear people saying, buy property with no money down. That doesn't happen. It happened in residential and we had 2008, but in commercial, it's not going to happen because it's too risky.
So moving markets, having a financial vision, reinvesting profits back into the business is a good signal to banks. What are some other pearls of wisdom that you have for real estate firms, developers, perhaps on making data-driven decisions or building trust with banks?
Be realistic going into the deal. Be realistic with your projections. Don't go in with rose-colored glasses. Be conservative with your numbers, and you'll generally do okay. If you go in thinking you're going to kill it with a deal and your numbers are like unrealistic, you're trying to like make it look better than it is, I've seen a lot of that, and I could see through that. You're not going to fool anyone. The deal has to be right.
Yeah, it's got to be right for all parties involved.
Exactly.
Let's close out that section, and then let's talk about some real world wins that you had. You shared that story about negotiating with Wells Fargo in the building in Illinois. What are some other wins, or what are some other like feathers in your cap that you have from your experience in this industry?
Over the past 20 years, I must have done every single kind of real estate deal, whether it's office, flex buildings, which a flex building is generally an industrial building, which could be a warehouse, light manufacturing, or even manufacturing. Those buildings seem to do well. Office buildings, which is really rough right now. We finance office buildings, but since COVID, it's been a tough market because people aren't going back to work, but they're starting to. I think they're starting to. Companies are really pushing to get people back into the office, so hopefully that'll change. And another area is residential apartment complexes like we own. Those are good because they're always in need. There's always a high demand for apartments, especially as the economy softens. People can't, and the interest rates are higher. People can't get the mortgages they want, or, so they have to rent longer. It works in both markets. It works in good markets and bad markets. It actually probably works in poor economies a little better because people can't get into their dream home.
I think that's a great segue. So why is now the time to invest in a fractional CFO if you're a developer or real estate firm?
Well, the market is really difficult. I hear it from a lot of developers. They can't find the deals. They complain about the interest rates. Well, if you structure the deal right, the interest, like I told you with our deal, if you structure the interest rate right, and if you're conservative, you could withstand a little higher interest rate. One of the issues is they're so used to 0% interest for over the past 20 years. They don't, I'm a little older, so I remember when in the 80s when interest rates were 14, 15%, and people still bought houses. Now, granted, interest rates went up from like 6% to like 15%. Now they went up from like 2% to 7 or 8. So as a percentage, they went up a lot more. So it makes it a little harder in this market. Plus the valuations are very high, a lot higher than they were then. So there are differences that make it even worse today than it was then. But if you have the proper advice, you can definitely weather this storm. You can definitely weather the market the way it is now. And I've been through a lot of cycles. I've been through this cycle at least 6 times since the 80s.
Can you explain that cycle? What is the cycle that you're referring to in a directly related to the real estate market? And where are we now, and what should we expect?
Well, it's the economic cycle. What I'm talking about, the economic cycle, the boom and bust economic cycle that we're always in, with the Federal Reserve raising rates, lowering rates. And it's not exclusive to the real estate industry. It's all over. But in the real estate industry is very interest rate sensitive. So we have to watch. Now, the Federal Reserve can only control the short-term interest rate. And we have a situation now which is pretty unique in the market. In all our boom and bust cycles that I've seen, generally, if the Federal Reserve lowers interest rates, they lower the short interest rate, the 10-year Treasury follows. That's not happening now. Where the 10-year interest rate is following the short-term rate. So at least not consistently, but it's been a little stubborn as far as going up when the short interest rates are being lowered.
And how does that impact the real estate industry?
Well, the real estate industry is not focused on the short-term rate. The price of mortgages is based on the 10-year Treasury. So if the 10-year Treasury is doing the opposite of what the Wall Street Journal prime rate is doing, that's a bigger problem for the real estate industry, because they don't care about the prime rate. They're not based on the prime. They're based on the 10-year Treasury. So that's what we're looking at.
Lou, if folks that are watching this, if they want, what action should they take? Where can they find you?
LinkedIn. I'm available on LinkedIn. I have a page there. My website, navigatorcfo.com. That's the name of my company. You can send me a message. I have my email address there, and you can send me a message, and we'll talk.